Nutrien just reported a top-line revenue beat, but a bottom-line EPS miss for the second quarter of 2026,
Their revenue actually came in at $10.81 billion.
which is up 3.6% year over year.
Right, and that beat the consensus estimates that were hovering between like 10.44 billion and 10.70 billion.
But then you look at adjusted EPS, and it missed. It came in at $2.61 against a Wall Street consensus of $2.70 to $2.89.
Down from 2.65 a year ago.
Exactly. And on the guidance front, management raised the lower end of their full-year 2026 potash sales volume guidance.
Yeah, that's now sitting between 14.2 and 14.8 million tons.
They also lowered their capital expenditure guidance by about $50 million, bringing it down to a range of $1.95 billion to $2.05 billion.
While maintaining their EBITDA targets for nitrogen, phosphate, and retail.
But, the market completely punished the earnings miss and just ignored the revenue beat.
It was a brutal reaction.
Shares slipped 2.31% to $65.38 in after-hours trading, and then it just continued to slide in subsequent sessions, hitting 64.42 amid a broader sector sell-off.
Like I said, brutal. When the market sees an EPS miss like that, the instinct is just to sell first and ask questions later.
They completely ignore the fact that the company brought in hundreds of millions more in revenue than anyone expected.
Right, which is wild.
And if you are managing your own portfolio, seeing a massive company beat revenue like that but get crushed on the bottom line, it's incredibly frustrating.
Oh, absolutely.
It leaves you wondering what is actually happening beneath the surface. So today, we're doing a deep dive into a huge stack of sources for you.
We've got Nutrien's Q2 earnings release, analyst research notes, meteorological forecasts.
And even some geopolitical trade data. Our mission here is to figure out if this messy headline EPS miss is actually masking, one of the most powerful pricing power stories in the market right now.
Because when you look at how this business is actually operating, the headline numbers just do not tell the whole story.
They really don't. How does a company beat revenue by that much and still miss EPS?
Well, the only way to understand it is to look at this massive structural divergence between two of their key upstream segments.
Okay, let's dig into that.
You really have to look at the total financial collapse happening in their phosphate division.
Collapse is a strong word, but yeah, it was absolutely gutted this quarter.
Exactly. And the primary culprit wasn't like a lack of demand from farmers. It was surging sulfur costs.
Let's break down the actual mechanics of that. Why is sulfur dictating the profitability of a phosphate fertilizer business?
It basically comes down to the fundamental chemistry of how you manufacture the product.
Right. Good.
To make phosphate fertilizer, you can't just, dig raw phosphate rock out of the ground and hand it to a farmer.
Because the phosphorus in that raw rock isn't water soluble.
Exactly. So the plants can't actually absorb it. You have to treat that rock with massive amounts of sulfuric acid to break it down.
Oh, wow. So sulfur is just an unavoidable critical input.
Totally unavoidable. It's the lifeblood of the entire division.
So when the price of sulfur spikes globally, Nutrien is just trapped. They have to buy it.
Yeah, they have no choice. And when those raw input costs spike faster than you can pass them on to the consumer,
your manufacturing margins get completely crushed.
Right. Phosphate-adjusted EBITDA plummeted 75% year over year.
To just $23 million, right?
Yes. But what really jumps out of the financial statements is that this sulfur price spike pushed their gross margins for the segment into negative territory.
Wait, negative territory?
Yeah, they are effectively losing money on the core economics of producing and selling phosphate right now. Every single ton they produce is burning cash.
That is a disaster. But then, you look at the other side of their upstream business and it's like a completely different universe.
It really is.
While phosphate is hemorrhaging cash, the potash segment just delivered record first half production and sales.
They generated $1.24 billion in adjusted EBITDA for just the first half of the year.
It's crazy. It's like having a V8 engine where the potash cylinders are firing flawlessly, but the phosphate cylinder is just actively leaking oil.
That's a great way to put it.
Like keeping this phosphate business operational while potash carries the entire load, it's like a farmer continuously watering a patch of dead toxic soil while ignoring their most fertile acres.
Right. If the potash acres are yielding these massive returns, why keep throwing money at the dead soil?
Exactly. I'm looking at their controllable cash cost of product manufactured for potash, and they kept it below 60 Canadian dollars per ton.
Which is incredible.
That level of cost control is wild. How are they doing that?
A huge driver of that cost control in potash is aggressive mine automation.
Like robots.
Kind of, yeah.
Yeah.
We aren't just talking of traditional miners with pickaxes or even standard heavy machinery anymore.
Okay.
They are utilizing autonomous boring machines and like advanced teleremote technology.
So people are driving them from far away.
Exactly. Operators are running complex extraction equipment from the surface, completely away from the actual rock face deep underground.
Oh, wow. So that dramatically increases the continuous running time.
Because you don't have the same shift change
Or
delays.
safety limitations, right?
Right. It reduces safety incident downtime and fundamentally just drives down the per ton extraction cost.
It creates an incredibly efficient cash-generating machine.
It really does.
So we go back to that dead soil analogy. At what point does management just, fence off the dead soil, the phosphate segment, and redirect all their capital to the automated potash acres?
Well, management is actually well aware of the math. They aren't just blindly accepting the negative margins.
Okay.
They are actively reviewing strategic alternatives for the phosphate business.
Strategic alternatives, that's usually corporate speak for we're selling this.
Pretty much.
Yeah.
And they are throwing the Trinidad nitrogen facility and the Brazilian retail business into that review as well.
Wow, okay.
Yeah, they've already divested roughly $1 billion in non-core assets since the fourth quarter of 2024.
So they are moving fast.
Very fast. And they actually expect to receive formal bids on the phosphate business by the end of 2026.
This is a very clear signal regarding their capital allocation philosophy then.
Absolutely. If an asset cannot generate a positive return on capital, they're going to sell it to someone who thinks they can fix it.
And use that cash to reinforce their strengths.
Exactly.
So if phosphate is effectively on the chopping block and potash is carrying the upstream load, the core of this whole business is shifting heavily onto the retail and nitrogen segments.
It is.
And here, the numbers in the retail segment reveal this really intense tug-of-war between shrinking volumes and aggressive margin expansion.
Right. So retail actually saw crop nutrient sales volumes drop 12%.
Down to 4.85 million tons. For most retailers, moving 12% less physical product would absolutely decimate profitability.
Oh, it would be a bloodbath.
But retail adjusted EBITDA barely budged. It dipped just a fraction of a percent to $11,131 million.
And the underlying mechanism keeping that EBITDA afloat is this massive expansion in margins on their proprietary products.
Let's talk about those.
Yeah, these are the specialized seed treatments, the unique chemical adjuvants that help fertilizers stick to plants,
Right.
and all the customized nutritional blends that Nutrien formulates in-house.
They aren't just selling bulk commodity fertilizers.
Yeah,
So-
they're selling highly engineered agricultural technology.
And the margins show it. Gross margins on those proprietary products surged 16% to $652 million.
Yeah, and looking at crop nutrients specifically, their gross margin per ton jumped 13%.
Up to $143, right?
Yeah.
Now, I noticed in the analyst notes that this massive jump in crop nutrient margins was heavily aided by a very strong Australian livestock market.
Yes.
Let's trace that line for you listening because it sounds totally disconnected at first. How do Australian cows and sheep drive a 13% margin increase for a North American agricultural retailer?
It's all about pasture management economics.
Okay, unpack that.
So when the Australian livestock market is strong, meaning cattle and sheep prices are really high, ranchers are highly incentivized to maximize the carrying capacity of their land.
Right, they want to graze more animals per acre to make more money.
Exactly. And to do that, they need lush, fast-growing, highly nutritious pasture grass.
Which means they need a ton of fertilizer.
Right. It requires intensive fertilization and early grower engagement. Australian ranchers started buying these high-margin crop nutrients earlier in the season.
And in much larger quantities just to ensure their pastures could support the profitable livestock.
Yes. So while Nutrien moved fewer physical tons of product globally, the specific products they moved in regions like Australia were significantly more profitable.
Which proves they have immense pricing power. Even though they shipped 12% less physical fertilizer globally, they pushed these high-margin proprietary products so aggressively that their overall profit basically stayed flat.
They're just squeezing more profit out of every single sale.
Here's where it gets really interesting, though. Pushing through a 13% margin increase per ton while seeing volumes drop 12%, that is textbook pricing power.
It is.
But at what point does price elasticity snap? Like, even if I want to protect my yield as a farmer, if the fertilizer gets too expensive, the math just stops working.
Sure.
Can they keep squeezing higher margins out of fewer tons before retail investors see real demand destruction?
It's a great question. But when you look at the agricultural calendar right now and the psychology of farmer behavior, the threat of demand destruction is actually lower than the pure math might suggest.
Really? Why is that?
Well, currently, crop development in key North American markets is tracking way faster than usual.
Right, because of the weather.
Yeah, and that early maturity suggests we are heading toward an early fall application season.
Okay, so when the harvest comes early, farmers have a longer window in the fall to prep and treat their fields for the next year.
Exactly. Furthermore, you have to remember that the psychology of a farmer is centered entirely on risk mitigation.
That makes sense.
If you are managing thousands of acres, you just cannot afford to skimp on a proprietary nutritional product if it means risking a failed harvest.
Right, the economic devastation of a crop failure far exceeds whatever premium they pay for these specialized products.
Exactly. And because of that dynamic, demand remains incredibly inelastic in the near term. Farmers are laser focused on protecting yield potentials.
So the crop is the ultimate asset, and the proprietary fertilizer is basically the insurance premium.
That's a perfect analogy.
You don't cancel your insurance policy right before a storm just to save a few bucks.
Never.
Okay, so if the retail side is squeezing massive margins out of farmers willing to pay for insurance, you would think their upstream nitrogen business, the actual commodity feeding those crops, would be booming.
Well, Nutrien did have a solid first half. They pulled in $1.12 billion in adjusted EBITDA.
Right, and the earnings report attributes a lot of this to lower natural gas costs and a successful turnaround at their low-cost Carseland facility.
Yeah, but then you look at the second quarter in isolation, and it saw a 25% volume drop.
Exactly. What happened there?
Well, that 25% drop wasn't, a sudden loss of market share or farmers refusing to buy nitrogen.
Okay.
It was almost entirely driven by specific operational bottlenecks. Most notably, they had a safe mode shutdown at their facility in Trinidad.
A safe mode shutdown. That implies something broke or became physically hazardous. What actually forces a chemical plant of that massive scale offline?
Usually, a safe mode shutdown in a nitrogen facility is tied to natural gas supply disruptions, or like pressure drops.
Because natural gas isn't just the fuel that powers the lights, right?
Exactly. It's the fundamental chemical feedstock for nitrogen fertilizer.
Right, through the Haber-Bosch process.
Yes. You take hydrogen molecules from the natural gas and combine them with nitrogen from the air to synthesize ammonia.
So if the local natural gas supply in Trinidad fluctuates in pressure, the facility just shuts down.
The safety systems automatically trip into safe mode to prevent a catastrophic chemical failure, yes.
Wow. Which circles us right back to why management is actively reviewing strategic alternatives for that specific Trinidad asset.
Bingo.
The North American nitrogen footprint benefits from some of the cheapest, most reliable natural gas in the world.
And Trinidad just doesn't have those same structural advantages right now.
So the gas supply issues make it an operational liability, dragging down an otherwise highly efficient operation.
That is the absolute core of the transition story playing out right now. You have a management team that is methodically identifying the dead weight.
The negative margin phosphate business.
Right. And the operationally volatile Trinidad nitrogen asset. And they are moving to shed them.
Leaving behind a highly automated potash operation and a retail segment flexing serious pricing power.
Exactly. But, you can't view these internal company mechanics in a vacuum.
Right.
To understand if the stock is a value trap or a coiled spring at its current mid-60s share price, we have to look at the global macro catalysts developing in the background.
And if you're looking at your portfolio right now, seeing an earnings miss alongside an incredibly low valuation is enough to give you whiplash.
Oh, for sure.
Barclays just lowered their price target on Nutrien to $78, citing profit adjustments and the near-term earnings risk from that EPS miss.
Yeah.
Yet, when you dig into the fundamental health of this company, the stock has a perfect Piotrowski score of 9.
Which is huge.
For those of you listening who might not track that specific metric, a Piotrowski F-score of 9 is incredibly rare.
It really is. It tests 9 different criteria across profitability, leverage, liquidity, and operating efficiency.
Right. It looks at things like whether the company has positive operating cash flow, whether they are paying down debt, if their gross margins are improving.
And hitting a 9 indicates absolute peak financial health.
Add to that, it trades at a forward PE around 11 to 13.5 and boasts a massive 7.3% free cash flow yield.
Crazy cheap.
It feels like a massive disconnect. Is the market just completely overreacting to the Q2 EPS miss?
Well, the market is hyper-focused on the immediate, tangible drag caused by the phosphate segment.
Because markets despise uncertainty and negative gross margins.
Exactly. They are heavily discounting the stock today for that near-term risk. However, to understand if this is an overreaction, you have to look at two massive tailwinds that could violently shift the supply and demand dynamics for Nutrien's core products.
Okay, what's the first one?
First, meteorological data currently shows an 81% probability of a strong El Niño weather pattern persisting through late 2026.
Wait, how does Pacific Ocean water temperature translate to a company's fertilizer sales?
Extreme weather volatility.
Ah, okay.
El Niño historically creates highly unpredictable weather patterns globally. We're talking severe droughts in some agricultural regions and intense flooding in others.
And when farmers face volatile weather, they fiercely protect whatever crop yields they can get.
Exactly. They over-index on fertilizer to ensure the crops that do survive have the maximum nutritional support to actually reach harvest.
It creates a structural surge in global fertilizer demand.
Huge surge.
So that insurance policy mindset we talked about earlier gets amplified by a factor of 10 when a farmer sees an El Niño forecast.
Exactly.
Okay. So demand is poised to spike globally. What is the second tailwind?
A major supply shock in the nitrogen market.
Oh.
The ongoing geopolitical conflict involving Iran has effectively removed approximately 8 million tons of annual urea exports from the global market.
Wow. And just to be completely clear for you listening, we are strictly analyzing the market economics of this geopolitical situation here, not taking any political sides regarding the conflict itself.
Of course. But the raw math is that 8 million tons of urea have just vanished from
Wow.
global trade flows.
And urea is the most widely traded nitrogen fertilizer in the world, right?
Yes, it is a critical source of nitrogen for crops globally. That significantly tightens global supply.
When supply tightens that dramatically and demand simultaneously holds steady or increases due to El Niño basic economics dictates that prices must rise.
It creates a severe structural deficit. And Nutrien is uniquely positioned to capitalize on that tightened supply because of their low-cost North American production base.
Oh, because if global urea prices rise due to the Iranian supply shock, Nutrien's profit margins on their North American nitrogen just expand instantly.
Exactly, because their input costs, primarily that North American natural gas, remain extremely low and stable.
The cash generation potential of that setup is enormous, and we are actually already seeing management aggressively deploy the cash they are generating.
They are. In the first half of the year, cash provided by operating activities actually increased 12%,
Yeah, they took that cash and returned $848 million to shareholders.
which provides a dividend yield of roughly 3.3 to 3.4%, paying out $0.55 per share quarterly.
But the most aggressive move was stepping up their share repurchases. They accelerated buybacks to 75 million Canadian dollars worth of stock per month in the third quarter.
Buying back your own stock aggressively when you have a 7.3% free cash flow yield and a perfect Piotrowski score, that is a management team pounding the table saying, the market has mispriced our business.
Right. They are utilizing the cash from the highly efficient potash and retail segments to shrink the outstanding share count.
All while the stock is artificially depressed by the phosphate drag.
They are basically buying their own company at a massive discount.
It's a very smart capital allocation move.
It really paints a picture of a company undergoing a ruthless, calculated transition. They are cutting the dead weight while the core engine runs better than ever.
The market is punishing the present because of a messy EPS print, but they might be entirely mispricing the future.
Which leaves you with a final thought to mull over as you watch this stock over the next few quarters.
Yeah.
If Nutrien successfully sheds its struggling phosphate division and those operationally volatile Trinidad assets by the end of 2026, you are left with a highly automated, low-cost potash and retail giant walking straight into an El Niño supercycle with tightened global supply. It's quite the setup. Will this Q2 earnings dip and the subsequent sector sell-off be remembered as the ultimate entry point for the patient investor? It is definitely a story where you have to look past the headline numbers to see the mechanics of what they are actually building. Make sure you follow the show for your daily deep dives into market-moving earnings reports just like this one. We'll keep looking under the hood so you don't have to.